Talking Point. I'm your host, Dheeraj Shah, and it'll be important to digest or dissect rather the texture of this market with Vinod Karki of ICICI. He needs an introduction, writes all the key strategy notes that come out from the house. And we'll kind of reverse the chronology as I was telling Vinod just before the shows went on air. That we'll start off with the short term, the micro, and then end with the larger, bigger term, which is what his specialty is, so to say, as well. Vinod, great having you. Thanks for joining in.
Thanks, Neeraj. Good morning.
So, Vinod, the very near term, last week, the markets were in this grip of this whole Hindenburg, Adani to and fro, and that brought about nervousness not only in the group stocks, also in banking and some of the texture of some of the others. And there is, of course, the big event of the budget, coupled with the Fed meet that very day. So how do you look at the texture of the market in the very, very short term, which is the next 3 to 5 days? I know you don't look at that very short term piece, but I'm still urging you to kind of look at it for us.
Yeah, so if you just roll back a bit, last year, India outperformed significantly. And we were of the opinion that, we have reached a point where the optimism is really rising. And such is a time that, when optimism rises significantly and you have any event which creates doubt in the mind of investors, that creates volatility. So I think that's what is playing out right now. You don't have any margin of safety much when when valuations really spiked around 20 times forward, and you then have some uncertainty unleashed by these kind of events, and that causes volatility. And and going into budget, there are talks about capital gains and things like that. So that creates uncertainty, and investors don't like uncertainty. So I think it's a culmination of two factors that we reached kind of a peak valuation, just entering 23, outperforming the entire global markets, emerging markets. And then this unleashing of few uncertainty events, which is taking its toll on markets. But the underlying theme of the market, where the economy and the profit cycle is being driven by the investment and credit cycle, I think that remains intact. I don't see any risk to that at this point in time so far. And also about micros, I mean, if you look at earnings so far, I was pleasantly surprised that so far, if you look at the earnings, the beats are outpacing the misses broadly. Inline and beats are outpacing the misses. So that's also a good sign that underlying demand is good and the inflation pressure is going off some of these companies. So that's a positive in my view.
Yeah, most certainly. IT, banking, to an extent, autos, the numbers are looking pretty decent, you have to admit. Okay, I'll talk about that too. But just first, a bit of a hypothesis. If indeed two events happen, which is that the Adani FPO, as they have said, moves ahead successfully, and the budget doesn't tinker too much with either the fiscal discipline or the glide path, or there is no big devil in the detail around taxation, around fiscal deficit, what have you, then do you think the recent correction that we've seen in the last few days, as well as if you take it from the highs, the nearly a 7.5% fall, does it take the sting out of the valuation argument that people have long held in the last quarter of 2022 and coming into 2023?
Let's see, the valuation angle remains. So we are expensive, and we had turned more expensive when we reached almost 19,000. So we have scaled back, so that's helping a bit. But broadly, this valuation angle will still play out because some of the other emerging markets are quite cheap that way compared to India. What will happen if the things that you just talked about is it will give a respite to the market. And it may go back to that range, which was the case, 18,000 plus kind of a range. But to really spike from there, we need a flurry of earnings surprises and a bit of monetary policy showing real signs of easing. These two things will really spur valuation. So that will really, kindle some outperformance. So, but these two things have to follow. One is this uncertainty that we have been seeing over the past few days, and so that needs to be behind us, and we need to see a continued earnings trajectory, and coupled with the quantitative tightening cycle angle that we have been seeing over the last year easing, and people actually believing that we may enter a quantitative easing cycle. So that will spur market, in my view. Otherwise, I think it will continue to remain in the range-bound manner because we are at the upper end of the valuation range.
Got it. One more micro question. Have you had a chance to ponder over or reflect upon this whole recent saga around this research report, or this report? I wouldn't call it research, but a report that was filed, and the subsequent damage that has happened, not just to the stock prices of the Adani Group, but the overall sentiment around even banking as well. And what could the possible stock market implication of something like this be? I'm not getting into the details of what you thought about the notes per se, the responses, purely restricted to the markets angle. Have you had a chance to think about it?
So if you look at broadly, I think the weightage of these stocks in the overall Nifty or other indices, I don't think they are pretty big. So I don't think they have a systematic risk impact to the indices. And there are studies also I saw that the banking sector is not overly exposed broadly. And it's not as if all these assets are bad or things like that. So I think from a systematic perspective, broadly speaking, this is one of the events that we keep seeing in markets, and there is no systematic risk in my view. But I haven't gone through that, and I am not qualified to what you should say, comment on these things, on a stock specific thing. But broadly, that's the view, that they don't pose systematic risk in my view. Broadly.
What I also meant from a market angle was that there's some nervousness recently that has crept into the bank Nifty as well of late. Now, my question, therefore, part two of my question, therefore, is that do you reckon that this could be a larger weakness around the budget, around what some people believe might have been peak performance from a banking perspective the quarter gone by, because NIMs will start getting compressed a little ahead? Or are you still constructive on banks and would use weaknesses? If you were trading, then, or if you were investing, then would you use weaknesses to get into the space?
Yes, absolutely. I have a lot of confidence in the overall financial sector. The way we are bottoming out in terms of a multi-year NPA cycle, and the credit cycle, especially the industry side of the credit cycle, just about picking up. And so I think structurally, I find nothing of an issue, because these are cyclical moves, multi-year cyclical moves. And you will always have within these moves some hindrances, some impacts here and there, which kind of creates uncertainty. But the underlying theme in terms of whether banks are undercapitalized, or whether the credit growth is not coming through, or the quality of assets is turning sour, I don't think we're too early in the credit cycle to talk about these things. Obviously, at some point, these will hit us back. That's the nature of all economic cycles. You reach a bottom and then you start building up, and finally the whole thing replays unless you're careful about it.
Okay, and would the argument therefore extend to PSU banks as well? Because the jury is split right down the middle. Some people say that there are not enough sectors to create a headache of bad loans for the banks just now, just as yet PSUs. And there are some who are saying that it'll hit sooner rather than later. So why get into that pocket right now? Might as well stick with private banks. So is it an absolute case of avoid PSUs and stick to private, or are you and leave SBI out? That's a different kettle of fish. But are you sanguine on some of the PSU banks as well after the run up and the subsequent small correction that we've seen?
From a broader perspective, I would always go with the larger names within this space, because they are better equipped to take care of an issue if at all it arises. But as I said earlier, these are the earlier. These are the beginning of a credit cycle, a releveraging cycle in India. And NPAs are pretty low. So typically, that's not how things fall off a cliff in one line, if I were to talk about, So these things build up. We have a good real estate cycle picking up, a whole investment cycle picking up. So they don't fall off a cliff in a hurry. It takes time to these things to build up, really leverage up the balance sheet, and reach a point where you get overconfident about leveraging your balance sheet and getting returns out of those leveraged bets, and get into wrong capital allocation. So I don't think that stage has been reached. Investors and corporates clearly, they are thinking twice, thrice before embarking on a capex cycle, having seen what happens because of bad capital allocation in the previous cycle. So this is not the phase where corporates are overconfident. They are taking these investments, but with caution. So that's a good sign, and they are generating enough cash flows right now to support these investments and taking on more debt right now, basically.
Right now. Got it. Okay, now before I move, I've focused a bit on the micro. Before I move to the macro, I'm just using one more aspect of both, a combination of micro and cycles maybe. 2022, Vinod, maybe was a year split into two halves, in that the first half, or the first maybe eight, 9 odd months, saw very strong performance from value. A bit of a growth texture came back as well. But if I look at the showstoppers for the last 6 odd months, anything which was very expensive valuation and showing some chinks in the armor around growth has gotten punished very, very badly. And this earnings season, maybe the poster boy of that is Dixon Technologies. So the point I'm trying to make is, we've seen that happening to some paint companies, we've seen that happening to some building material companies, we now started seeing that happen to some manufacturing companies as well, which probably still show growth, but some chinks there. So my question to you is, would you believe that 2023 could well continue to be the year of value or growth at very reasonable price, or at some point of time, high growth and high valuations may make a comeback?
In fact, our title for this year ahead note was that value capital intensive stocks, cyclical stocks will continue to outperform rather in 23. The reason is very simple in our view. We're not complicating the whole theory. It's that, from 2012 to 2021, when the low volatility, expensive quality stocks they outperformed, was because of the nature of the economy. The demand in the economy was largely being sustained by private final consumption expenditure at the cost of gross fixed capital formation and the credit growth. So if you see, it was a decadal downtrend in gross fixed capital formation, credit growth, and the real estate cycle. Now, what is happening is, from 21 onwards, all these three are picking up, and credit more from the industry side. So that's why this is just showing up in terms of the stocks which are outperforming. So which are the stocks which fall within the capital intensive, the credit cycle, and the investment cycle related stocks? Those are the stocks which are typically the cheaper ones, the value stocks, basically. So the value is outperforming because they are turning. There is growth in those stocks, right? And what is happening is, during this 2012 to 21 period, while the investment credit growth was on a downhill, what was holding growth was the quality growth stocks, as you may call it, the 10-15% on a sustained basis, high ROE, cash flow generating companies. What was happening was something which was at 30p became 70-80p during this decade, right? Now, what is going to happen is, they're still going to get this 10-15% kind of earnings growth. But what is happening, the other side of the market, which is very cheap, is now actually showing higher growth. Some of these corporate banks, industrial, they will show 20-25% growth, and they are way cheaper. So that's the crux of the whole thing, that why these stocks are outperforming and why they will keep outperforming. It's not a magic. These cheaper stocks are showing higher growth because of the underlying demand in the economy. So unless the investment credit cycle breaks down or the real estate cycle breaks down, I don't see these stocks underperforming, because finally investors chase growth wherever it is coming, from the investment side, credit side, or the consumption side. Wherever growth comes, stocks will be bid up. So that's what is the reason.
Got it. My final question really, I assume you have 2 more minutes.
Yeah.
Okay, my final question is around whether you've looked at the nature of flows, because the most common argument is that, and very likely that is the argument I would subscribe to as well, that because China was looking so cheap, a lot of EM flows or otherwise would be pulling money out of India, Indonesia, etc., moving into China, maybe moving back to US as well, because tech out there is cheap, who knows. So my question is, in a year wherein both US as well as in EM China specifically, despite the run-ups, are looking a lot more reasonable than what maybe slightly expensive EMs like India might be looking. How do Indian markets fare for a better part of the year, ceteris paribus?
Yeah, so you have to look at asset classes. So last year, if you see, it was a quantitative tightening cycle, and emerging markets in general got outflows, which only reversed during the latter half of the year. This year, what we are observing is that the aggressive quantitative tightening cycle by the US Fed may be ending, and there are some projections, and there is hope that by the end of this year, if the US really goes into a recession and interest rates and inflation dip, there is a good chance that the QE might start, because the Fed will be at 5% odd rate, So that's enough firepower in my view. They entered COVID with around 2%, and they brought it down all the way to 0 because they had to fight a recession. So if you're making a case that you're going to end into a recession by the end of this year, and the way inflation is going down, be it shelter costs or gas prices or commodity prices in general, so I think there's a good chance that you might see the end of QT, aggressive QT, and maybe at the end of the year, some bit of quantity easing. So in this environment, emerging markets with their relatively higher growth to developed markets there's a chance that they will outperform. Now, within emerging markets, it is possible that India already outperformed last year. It is possible that we may not do that again this year. But to say that will we have a negative flow, I don't think, because it's a basket of asset class emerging markets. So if there is an allocation towards emerging markets, India will get its share, maybe lesser, because the others are cheaper. But you can't make a case that, okay, India will see outflows and others will see inflows in this kind of environment.
But we're seeing that happening, in the last few weeks, right? India has seen outflows. China and maybe a select other EMs have continued to see inflows. So that has happened.
Absolutely. Yeah. So we saw that, but you have to look at it from some perspective. So if you look at the December quarter shareholding data we now have for Nifty 50 companies, we actually saw that the shareholding went up of FPIs actually for the Nifty 50 companies. Overall, India stocks, it held at around 17%, right, for this period. So what is important is you have to give it some time, maybe a quarter or so.
Okay.
Ebbs and flows will be there. You can't make a case out of it actually. But overall, if you look at the shareholding pattern for the December quarter, what we observed was that the Nifty 50 shareholding of FPIs actually nudged up by 50 basis points. Post that, obviously, we saw some selling, but that would have evened out the buying and selling and that kind of a thing. So we have to look at it overall. I think there is no case to be made that if emerging markets overall get closed, that India will get outflows. They may get lower flows for sure, but yeah.
Okay. Well, I think we'll have enough chances to talk about all of this during the course of the year as well. Vinod Karki, always a pleasure talking to you. Thank you so much for
Thanks, Neeraj.
talking to us today.
Thank you, Neeraj.
Viewers, thanks for tuning in.